G'day folks, welcome back to another update, and today we're talking about Bitcoin and Ripple, and we're including Ripple in the Bitcoin analysis beginning today. So the chart is showing a potential bullish breakout on both, so we'll include the backtesting. Don't forget to hit that like and subscribe button to support the channel. In terms of the outlook, as of today, April 23rd, Bitcoin remains fundamentally strong, bolstered by institutional adoption, the approval of spot ETFs, and its post-halving scarcity, with analysts projecting potential highs between $100,000 and $125,000 this year. Ripple's XRP is gaining momentum following a favourable SEC lawsuit resolution, increased institutional use in cross-border payments, and bullish technical patterns suggesting a possible breakout beyond 250 in the near term. So first, looking at Bitcoin, we always start with the long-term trend. So if you're trading on the daily, we look at the monthly, the weekly, and the daily. So here on the monthly, we've got the price still above the moving averages, although the CCI 150 is broken down into that moving average range. So we might see a break to the downside, so just be cautious. That's a somewhat neutral positioning so far. On the weekly, it turned bearish back in around about February this year, once that CCI broke below the moving average, and that was a result of this bearish divergence. But since then, we've had a bit of a retrace to the upside, and the CCI has broken into that moving average. Likewise, the price has broken into its respective moving averages on the weekly, so giving us a neutral positioning. On the daily, again, you can see there it's bounced off that minor support at 74,429. The CCI is above the moving average, and so is the price, and that was a fresh breakout. And the CCI 1500 down here, which helps smooth out the overall trend. It's a bit of a lag. They're all indicators are lagging indicators, so there is no indicator that's perfectly spot on. Even though it's lagging, it does give you a confirmation here that it's actually turned bullish, but you could have gone long during this period when both the price and the CCI broke above the respective moving averages, and I'll show you the back test for those in a minute. Let's go to the intraday chart. So remember, just back before we go into the intraday chart, if we look at the three charts again, if you're trading on the 1 hour or the smaller time frames, you make that the time frame you're trading this smallest chart here. So if you're trading the 1 hour, for example, you'd make this the hourly, you'd make this the daily, and you'd probably make that the weekly, just to give you an overall trend of the intermediate and lower level trends. So again, let's go to the 1 hour time frame. We've got the daily here. Again, we would have gone long during that period back there and taken long trades predominantly. Before we go to the back test, again, just notice here we had a bearish divergence, lower highs on the CCI versus higher highs on the price, and that broke down, hit our minimum target range, then it bounced out of there. And that minimum target range is measured by, if we draw a Fibonacci, take it down to the low before that divergence started, that's at 23.38% low. So we take it back to a significant low, which was that area there. So that's a minimum range it retraces to before, in this case, it bounced out of there. Sometimes it breaks right through that and even goes beyond 100% sometimes. So we can't tell. We take it one step at a time. So that's so again, long positions only. Before we go to the long positions, let me show you the back test for these short positions back here. So on the short positioning, let me just get rid of that Fibonacci. So again, I've started the back test here for the stop loss approach and the average down approach, and that period is started back here on the daily when the CCI broke below the moving average, and so did the price. So we've gone short during that period, and that was confirmed by this downtrend on the CCI 1500. So, and you would have stopped taking short trades. You've got to close out your positions when that, zoom in a bit, when that CCI breaks into that moving average range or about to break into it, you would have stopped your positions. You would have closed out your positions, and that's marked by around that period there. Let me just get that right. So yeah, you can see there on the right side, the stop loss approach is generated at $1,007, and the average down is generated $2,400, even though you had a bit of a loss with in more recent trades. But overall, the average down has worked better because it doesn't stop out as often. Now, if we go to the long positioning, that's this period here, and that's where we would have started going long from that point. That's indicated again here on the stop loss and the average down approach, and you'd still be in the trades today because that hasn't hit the moving averages of the CCI on the daily. So you'd still be in the trade. Now the stop loss has lost somewhat. It's dropped below our baseline of 100,000, so you're down about 400 and something odd dollars. Whereas the average down approach has generated 1,919 with a closed out trade there. So good return, and that was predominantly with a bit of a averaging down there. We had a bit of a drawdown, but again, you would have kept the trade open with that being above the moving average on the daily. So for Ripple on the monthly, it's a bullish momentum on the price chart. You see it's well above its moving averages with a nice big gap there. There's no CCI for it drawn. The history is not showing it there. On the weekly, likewise, that gap up. And since then, the CCI is broken down below our moving averages, giving us a bearish momentum. And the price has actually come back towards that moving average. Not quite bearish on the price, but very bearish on the CCI. So I would not be going long at this point. On the daily, again, similarly, the CCI broke down below the moving averages and has been fluctuating mostly below that moving average on the CCI 150. And then this CCI 1500 eventually turned down as well with a bearish momentum. And the price itself has been fluctuating just above and below that very narrow moving average band. And just the last couple of days has actually broken above on both the CCI 150 and the price charts. Now, I want you to notice here as well on the back test, we possibly might see a break to the upside, but you've got to be very careful because we saw a break there as well when it broke above on the price as well as the CCI, but also another break above there. They were two false breaks. Is this another false break here or not? That wasn't quite a false break. The price was still within that moving average band. So what I've done now, there's no divergence to talk of. That CCI is moving in line with that price. But if I show you the back test for the short positions, now I've started the short positions here around the 22nd or 23rd of February, and that was when this confirmed to the downside on the CCI 1500. I've started going with the short positions here on the stop loss approach. Now I would have stopped at it, I would have closed out the trades at each one of these little areas where the CCI 150 hit the moving average band, albeit very narrow band. I would have closed out the first trade there. You can see there on the right side, the stop loss approach has generated 12,062 if you're buying $1,000 worth of shares each time, and the average down approach has generated 13,485. I would have re-entered it again there, and then close it again there with possibly a small loss. Re-entered again short at that point, and then close it out again at that point there. So again, I'll just let it run through the whole period just to show you the effects. Now, granted, we're going to be stopping and starting the trades in those little areas I've mentioned, but had you let it go up until now, the stop loss approach would have generated about $8,000 and the average down would have generated about $30,000 if you're trading $1,000 lots. Now, again, just be mindful. It looks like a fresh breakout, but that could be a false break like it happened back here. So I wouldn't be going long too positively because we might get burnt. But what I've done here, I've drawn a back test there when it first started breaking above on those little areas as those false breaks. That's where the stop loss here and on the stop loss on the average down approach is shown. Now you'll notice on that first one where it entered and closed it out there, you could have got out there with a small gain of, well, not a small gain, but a nice gain of 4,200 with $1,000 trades made, and 4,300 roughly with another lot of $1,000 trades made. So you would have entered one lot of $1,000 at each one of those. Then gone long again at that point. Now I'd have to start and stop this program to show you the back test, but basically you can see how the stop loss approach has declined, and so is the average down approach. But had you kept it open until today, you would have used up all your accounts had you had the average down approach running. And again, that's why you got to be very careful and an experienced trader to use the average down approach. Alternatively, the stop loss approach has finally broken above nice highest point at this point because of those two candles in the last couple of days, and you'd be up about 11,400. So just be careful of the average down approach. So if you're new to trading, we're now including a weekly video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis, help you follow our daily videos. If you enjoy the content, keep me motivated to keep these videos going. Subscribe at least on a free trial to the Patreon page where I publish weekly bullish shares across various regions of the world's markets. Think of it as sitting down with me over a cup of coffee. Thanks, and talk to you in our next video.